All right, today we're digging into a really interesting puzzle in the industrial space. Wabtec Corp just dropped a stellar earnings report, and what happened? The stock went down. So what's going on here? Let's get into it.
So here's the setup. On one hand, you have a solid earnings beat. The company did great. On the other hand, the market's reaction was, well, a total head-scratcher. Stock closed down over 2%. This is exactly the kind of disconnect we love to pull apart.
So, what gives? What is the real story here? Is this just some simple profit-taking after a nice run-up, or is the market sniffing out some headwinds that those headline numbers aren't really showing? That's what we're here to figure out.
Okay, first, let's just get grounded in the facts. We got to look at the hard data, because by almost any measure you can think of, this was a really solid performance.
The bottom line? Absolutely impressive. Adjusted earnings per share clocked in at $2.32. That's a clean beat against what Wall Street was expecting.
And the top line, that showed some really healthy growth, too. Revenue was up 8.4% compared to the same time last year, hitting almost $2.9 billion. But here's where it gets really good. Their operational leverage was just on full display. Adjusted operating margins expanded by a full 130 basis points to 21%. I mean, that's a huge signal of efficiency and some serious pricing power.
So, when you put it all together, what do you get? It's a clean sweep. Wabtec beat on revenue, they beat on earnings. There's just no doubt about the strength of the quarter itself.
All right, so the numbers were great, but what was the story that management was telling on the earnings call? Well, it all centers on this multi-year strategy that they're calling the mix and margin thesis.
CEO Rafael Santana really set a confident tone right from the very beginning. He framed the quarter as a clear win, pointing to their execution across every single key metric as proof that their strategy is working.
And here's how they're doing it, how they're getting that margin expansion. It's really a four-part approach. They're optimizing their portfolio, getting rid of low-margin stuff. They're using disciplined pricing to stay ahead of inflation. They're growing their high-margin services business. And maybe most importantly, they are building a massive backlog of future orders. And hey, the numbers totally back up what they're saying. Their total backlog soared to a record $25.6 billion. A huge piece of that was an historic, massive $4.2 billion order from Kazakhstan. You combine that with strength in other international markets and a big turnaround in their transit business, it all paints a very bullish picture. Okay, so the results were great. The story was strong, which brings us right back to our big question. To understand why the stock dropped, we have to start reading between the lines of their guidance and what was said during the analyst Q&A session. First off, the guidance itself. Management did what's called a raise and tighten on Wall Street, so they lifted the midpoint of their earnings forecast for the full year, which that signals confidence, right? But they also narrowed the range. And this move is basically telling the market, hey, we're sure we'll land in this higher zone, but don't get crazy and expect a wild beat beyond that. It's a smart way of managing expectations.
The Q&A session, though, that's where the clouds on the horizon started to show up. Management said point blank that the biggest financial hit from tariffs is still to come. They're fighting to mitigate supply chain costs, but it's an ongoing battle. And they pointed to clear weakness in the North American railcar market. Builds are forecast to drop 34%. And all of this is happening against a very uncertain global economy.
So let's put this all together. How do we balance this stellar execution and this giant backlog against some very real, very clear external risks? Well, it's time for our verdict.
The bull case is pretty obvious, right? A record backlog, proven margin expansion, international orders are booming. But the bear case is just as compelling. You've got the unknown impact of tariffs, a weak domestic market, and just this general nervousness about the macro environment that's clearly weighing on how investors feel.
So after weighing both sides of the argument, our rating for Wabtec is market perform.
Look, Wabtec is a best-in-class company that is executing brilliantly. But at its current valuation, it feels like a lot of that good news, including that monster backlog, is already baked into the stock price. The external risks are just too big to ignore, and that justifies a more neutral, wait-and-see kind of approach for now.
And that brings us to our final segment, where we pitch an actionable idea. And let me be clear, this is an idea, not advice, based on this analysis.
So given this fundamental disconnect we've been talking about, fantastic results met with a pretty lukewarm, even negative market reaction, how might an investor strategically position themselves for what might come next? Okay, here's the pitch, a classic pairs trade. The idea is to go long on Wabtec while at the same time taking a short position in a competitor that's more exposed to just the North American economy. The whole thesis is that Wabtec's huge multi-year and heavily international backlog gives it this unique defensive shield that should let it outperform its more cyclical peers if the U.S. economy keeps getting softer.
This is not financial advice.